so much, you may even get tired of winning.
Are you expecting a recession this year?
I hate to predict things like that. There is a period of transition. It takes a little time.
Welcome to Is It Bad for the Economy, the podcast where we explore whether Trump's economic policies are helping, hurting, or just a load of hot air. My name is Kobi Tirey. I'm a Democratic media consultant trying to figure out how the Democratic Party can once again become the party of economic mobility and prosperity. And I'm joined by Banker Bill, a well-credentialed banker who's here to tell me whether Trump's wrong or I'm wrong. Folks, we're recording this on Friday, June 27th. If you have an immigrant parent like I do, you're clutching your passport a little closer today. And tomorrow, the Senate is voting for the first time on the big, beautiful bill, which, if you care about fiscal responsibility at all, has only gotten so much worse in the last 2 weeks since we talked about it on our last episode. I pitched Banker Bill a lot of topics for today's episode, but he only wanted to talk about one thing. Why, 6 months into Trump's term, we were once again in the situation where stocks keep going up, but people's sentiment, their vibes about how the economy is going, are going down. The Vibecession's back. So Banker Bill, do you buy into this narrative that this divide is growing between what the metrics say and what the average consumer thinks? And do you think it's a problem, or do you think that it's just going to keep generating social media content and people are going to keep making the financial decisions that they're making based on the inputs that they always have?
I do think there's an awful lot to this discrepancy between the sentiment and what we're seeing in the hard data. People, it seems, in the data, are making more on a real basis than they were maybe last year or 2 years ago. But nominally on both ends, you're making more. So you've seen costs go up. And so I think people have a perception of, my costs are going up, but my income's not going up. This is not for everybody, but I think for large groups of the population, their incomes are rising, and their incomes are rising faster than their expenses. But their expenses are rising, and that's creating some sticker shock. So their perception isn't necessarily as good as reality. And I say that because you continue to see such large amounts of money flowing into retirement plans, where their IRAs, 401ks. I know that's like an upper segment, but there's a lot of people now with legislation that's come over the last few years of opting people into retirement plans, that there are far more people saving than previously. There are cities where people are moving and it's very expensive to live, where you're talking 40% of your gross income on rent or housing. When you are starting out as a young person who may be moving to these cities from your university, and it's not just the Northeast, it's places in the South, the West, the Northwest that are having these issues where it is extremely expensive to live, and that creates more sticker shock. So even though, hey, I graduated college and these people are graduating and making money that would make someone who graduated in the 1980s blush after 10, 15 years in the workforce, they're making that now, but their perception of housing and the costs they're in are so much higher that, they don't feel as good about their financial situation.
I think the psychology of why a dollar leaving your wallet hurts a lot more than a direct deposit regularly coming in makes a lot of sense. We can all relate to it. Politically, though, I think the impacts are devastating because it exacerbates this general trend of this time where any negative news confirms all of our pre-held beliefs, assumptions about what's making the world worse, whereas any positive news is treated with skepticism. And one of the reasons why I beat this soft landing drum as much as I do is because as critical as you can be of the Biden administration, as critical as I am of the Biden administration, if we want things to get better, we have to tell the story of when things were done right. But how are Republicans ever going to give Democrats credit for getting things right, for doing a good job, when Democrats won't fight tooth and nail for that reputation themselves? Stocks are back to going up, just the way that they were ever since the pandemic, just the way that they have been for seemingly so long, even if this entire time, during the Obama administration, during the non-pandemic Trump administration, during the entire Biden administration, have just been feeling like we can't trust those stock numbers. Something's a little bit off. So, Banker Bill, what's your take on why the stocks are up again? Is it just that we've passed this Liberation Day moment, that Trump chickened out? Or is there actually some fundamental, foundational groundswell of economic prosperity that we should all be getting excited about?
Well, I think a case could be that the range of outcomes is narrower than 3 months ago, even if a few of those outcomes are bad. A weakening labor market could probably put a lid on inflation and is going to justify future rate cuts. The dollar is 6 to 10% weaker versus January on a trade weighted basis. And that benefits services companies who may be deriving revenue in foreign currencies and then reporting that revenue back in dollar terms. Yeah, there's a lot of risk on behavior in the market now as some of the the risks that were out there, the nuances or the lack of clarity that was in there, we're getting more. So we're probably not going back to the Liberation Day numbers, even if there are tariffs, or it seems like we're kind of settling in on some 10, 15, 20% effective rate number. Tariff revenue is coming in. And, it looks like stocks are at least positioned to, make further new highs through the summer, as long as the economic picture as it is today doesn't change through the summer.
Look, even I have to admit that we've walked away from the brink here. Did Trump chicken out, or are some of Trump's policies actually moving us in a positive direction?
No, we said it back then when they announced on the White House lawn there, I think it was in the Rose Garden, these 100%, 79%, whatever it was, those were effectively going to be embargoes. And within 8 to 12 hours of them going into effect, they pulled them back because of the market reaction. And ever since then, it's seemingly walking back little by little on that day. And that's how we just got back to, basically where we were. The all-time highs that we're hitting right now were hit previously, I think, in February.
So Trump chickened out.
Sure. Yeah. On the I guess the most extreme of the proposals, there are still tariffs. He's made good on that. So yeah, but on the broadness of Liberation Day, yeah, absolutely. Basically walked it all back.
One thing that's so confusing to me about that is that up and down the economic ladder, from the consumer to the executive, the sentiment seems to be wait and see. Will this sort of period of restored sanity really hold? How is it that wait and see, walk away from the brink equals consistent, I don't want to say super strong, but consistently positive stock market growth? Why is this chaotic status quo? Why does that still equal stocks going up as opposed to stocks going flat or maybe even down?
There's a lot to it. There's sentiment in terms of things like the AI trade. There's real earnings growth that's flowing through to the bottom line that you could see in the financial statements that these companies are growing and they are doing well. And, last but certainly not least is a lot of people's livelihoods are based on this. There's a huge, constant inflow into stocks. There's an inflow just by way of employment. Think of all the people that are contributing to their 401k every week, 2 weeks. So there's a huge tailwind consistently of dollars flowing into the markets. I mean, I'll just make it as simple as that.
I know you hate to speculate, but are you feeling like this stock market growth rate is sustainable? Do you expect that the most likely scenario is that we see growth of this kind of level for the rest of this year and beyond?
The S&P 500, it's up about 4 or 5%, right? 4.5%. If it goes up another 2-3% from here, hey, that's an quote unquote average year for the market. So that's pretty good. So, you've got more than half of the gains you could expect in an average year at the halfway point of the year. So, I mean, I don't know. There's always going to be risk out there. If you're in banking, you always take a risk management lens. So I'm always going to be maybe a little more cynical than other folks or the general public. But, there's tailwinds out there for further growth in the market. Sure.
I'm just asking you for your confidence level right now. And it sounds to me like it's just barely cautiously optimistic.
Yeah. Yeah, it's iffy. I mean, things like employment worsening and GDP growth slowing are considerations.
It's really funny. I had folks from both sides bringing GDP numbers to me this week. I had some Democrats bringing to me headlines about the fact that annualized Q1 GDP was down 0.5% as proof that Trump's economic policies were going to lead to economic ruin. But I've also had one of the few Trump supporters who listens to this podcast ask me, when are you guys going to talk about the phenomenal Atlanta GDP Now numbers, which really spiked a couple of weeks ago and still have the economy growing in Q2 at 3%. Banker Bill, before we even get into your analysis of whether GDP is going in the right direction, wrong direction, and by how much, what is going to be the official metric that we use to analyze, measure, evaluate GDP growth on the Is It Bad for the Economy podcast?
Real GDP, percent change from year ago, so of the prior year, seasonally adjusted at an annual rate, not versus the prior quarter, not versus 6 months ago, but comparing that quarter to the prior year's quarter. So we're going to compare Q1 2025 to Q1 2024. On an inflation adjusted basis. So real GDP in Q1 projected right now that I think we're through the first or second revision was 2%. I think that's fairly strong, but it's slowing from prior periods. So Q3 23 versus Q2 or Q3 22, your GDP growth was like 3.25. Then we went down to 3%, then through 2.75%. Now, we're down to 2%. So it's a good economy out there. The GDP is growing at a inflation adjusted rate of 2% per year. The economy is worth what? $30 trillion, right? So to be growing 2% per year, I think we had talked about it before. It was like the size of Sweden's GDP. I think that's a remarkable feat and shows the resiliency of the U.S. economy.
On previous podcasts, you've said that GDP is not the most important thing here. We don't need it to be red hot. As long as it's positive, as long as it's in that 1% to 2% range, then the other numbers, the interest rates, the employment rates, that stuff matters a lot more. It's at 2%. It's still in the healthy range, but you say it's trending in the wrong direction. How significant is that trend, and do you expect it to keep getting worse?
I think the trend, since it's negative, I take a negative view, right? I'm looking for that confirmation. It hasn't necessarily come through yet, but it seems like the trend is worsening. So the GDP growth is actually slowing at a faster rate than it had been in prior quarters. And you couple that with the underemployment and unemployment rate, the U6 rising over the prior year, and you couple that with continuing claims rising and starting to increase faster over the prior year, you get to something that, raises some risks.
The last time we talked about GDP in the Trump 100-day episode, there were a lot of headlines about how that Atlanta Forecast Now model was way down. And at the time, you told me that was mostly hot air for two reasons. One, we weren't looking at that Q1 of 2025 versus Q1 of 2024 rate, but also because the literal mathematical shift happening there was that money was going out of the country because people were trying to get all of their foreign goods, products, materials in as soon as possible before Liberation Day. Is there something similar happening here? Is there a sort of folks still trying to time the market, trying to time the tariffs, or has that all evened out at this point?
Oh, that's a good question. I think there's probably some of that. I think what you're seeing is maybe a higher frequency of orders with fewer total ordered at a time, and that would increase certain costs, right? But there's cover because of tariffs. As a consumer, we've kind of been blitzed with all these different numbers, 10%, 50%, 100%. So as a supplier or a producer or a good seller, you may be able to protect yourself a little bit by ordering more frequently. And then even though that might cost you a little bit more on a per unit basis, you might be able to get away with passing that along to the consumer.
And I think that makes a lot of sense to me, both from a numbers and from a vibe standpoint. From a vibe standpoint, if everybody's saying wait and see, that's exactly what you would do in that situation. In the numbers, that would look like a flat line or a just ever so slightly trending negative line, as folks are really just treading water. It sounds to me here like we've had a slight chickening out, that the Liberation Day stuff is behind us. The new normal has reached an equilibrium in terms of the GDP number. And now we're back to just having to wait a year to figure out how Trump's impacting things.
Yes. But even today, a headline was, we're cutting off all trade talks with Canada. And I haven't read details into it, but we're probably going to get headlines like that throughout the summer. And you may not see as much of a market reaction because it's a fool me once, fool me twice moment where the market has sniffed it out. They are assuming, I would think, participants are assuming that there is some kind of bottom where Trump will capitulate, right? And so that kind of faith or belief drives additional risk on behavior, to buy. Couple that with, like I said, sentiment about AI or productivity or corporate earnings. Take your pick.
Well, one thing that seems to be unequivocally positive right now, especially for consumers on the ground, is the price of energy. What makes you so encouraged about the price of energy right now? And again, do you expect it to hold, get better, or get worse?
So gasoline on a national basis is around 6% cheaper than it was year over year. This is shaping up to be the cheapest driving season since 2021. So that is a tailwind for consumers that was a drag in the prior few years, right? So that's getting cheaper. Northeast had this massive heat wave. I took a look at natural gas. Something like 35% of the country gets its energy through natural gas. Natural gas has been between $6 to $8 per million BTUs since December of 2022. It's basically just muddling along between $6 and $8. No breakout either way. Right. So that's been consistent. That's been something that people can count on. Even though we've gotten, I guess, headline after headline, that energy bills are really high and this and that. I think maybe a lot of that may be in distribution charges or generation charges and not so much in the price of the raw commodity itself. End result, I mean, gasoline, natural gas, the energy complex writ large looks like going into the summer, it's a tailwind for the U.S. consumer.
As you've alluded to already, you seem to be a little bit more concerned about the negative trends in employment than you are in GDP. But before we get into it, I just want to remind everybody, one of Banker Bill's top tips for staying sane when you're looking at economic metrics is not to look at the U3 number, which is the unemployment number that we usually see in the headlines. He likes to look at that U6 unemployment number, which includes everybody who's also underemployed, the folks who've got part-time work but really are hoping for and applying for full-time positions. What is that data looking like right now, and why does it have you a little bit more concerned than some of the other metrics?
We are coming from an historically low unemployment picture, historically low. It's under 5% unemployment rate, while employment to population ratios, so the number of people working versus total population, were also near all-time highs. However, over the prior year or so, underemployment and marginalized employment, right, that U6 figure is increasing. So it's increased from 7.4% a year ago, and we're at 7.8% now. And the high over the last 12 months was 8%. To give you a reference point, if we were in a recession, I would expect that number to be at least 9%. So like several other metrics I mentioned, GDP was another one. Is it a problem yet? No, but the trend is not your friend here. It's going up. It's going the wrong way. Again, couple that with continuing claims. People filing for unemployment back-to-back weeks. That's going up. Again, coming from a very strong position, a very low point, but it looks like in the next report, the 4-week average is probably going to be 2 million, which means in back-to-back weeks, 2 million Americans are filing for unemployment. That number is going up week to week, sequentially. And I'm smoothing it out by looking at a 4-month seasonally adjusted average, monthly average on that. I don't want to sound too negative. I really don't. But seriously, the trends are what they are. And the trend on some of these are negative, as we have some of these economic uncertainties driven by the political environment.
Do you have any sense of what's driving this negative trend? Is it general uncertainty created by the Trump administration? Is it longer-term economic trends? Does AI have anything to do with it?
I think it's all of the above you just mentioned. The U6 basically bottomed in December of 2022 at 6.6%. Ever since then, it's been making a slow grind higher. And now we're up to, as I said, 7.8. I think it's all the narratives you mentioned, I think are all playing a picture. I think the wait and see approach, can I do it with AI? Can I do more with less?
So we think the uncertainty is a negative driver here. That's Trump's fault. We think that AI is a potentially negative driver here. That's not Trump's fault, at least not yet. Is there any reason for optimism here? Do you see any trends that might push this number back up or at least stabilize it?
I would say oftentimes when unemployment starts going up, it starts going up very fast. This hasn't happened. October of 2022, we've gone up 1.2 percentage points in the U6. If we were entering like a particularly bad economic picture outlook, you'd expect that to just go much higher, much quicker. Hasn't happened. Maybe we settle around 8.5%, never hit 9. But again, 9 is kind of the number where if it gets above that, you would expect that there'd be particular stress.
I don't feel like I've experienced boom and bust cycles. I don't feel like I've experienced.
Well, you did.
No, I think we experienced this recession in 2008.
Yes.
And ever since then, it feels like certain numbers have been minorly trending upwards. Certain things have been getting just a little.
It's always
bit
how it
worse
is.
every year.
Always how it is.
No, I don't think that's how it is. It's not. I mean, they keep saying it was the longest recovery of all time. It was only interrupted by this once in 100-year event of the pandemic. And so
Sure.
we have not experienced the up and down. We've experienced stock markets
A
go
grind
up.
higher.
Everything else feels like it's been getting worse. Oops, we had this pandemic thing, but now we're back to the stock market goes up and we're all having a worse time.
Yeah, I could see how you have that perception.
Well, I do
got a
have
question
that
there?
perception. I feel like a lot of people have that perception. But
No, you're right. You're right.
is that a rational response to the fact that we've just been adults for 2 decades in slightly anomalous cycles, or is this a new normal?
That's a good question. I haven't thought about it in that way. I'd have to think on that and maybe raise that with some people further. See what I can drum up. But as looking at a student of history, I'd say no. There's been there's these cycles. That's it. They're oftentimes driven by technology.
What's your take on inflation right now? Are we heading in the right direction, wrong direction, or just more of the same?
Trending down, but still too high. And that's why you've seen the Fed sit right where they are.
Is it trending down, or is it stuck in this sort of slightly over 2%?
No, you're right. It's pretty range bound. Call it 2.25 to 2.75. I don't know, the past year or so.
Now, you know that I love to give Joe Biden credit for the soft landing. And every single time you say it wasn't Joe Biden, it was the Fed. And then I say, sure, but if we want folks to vote more rationally on the economy moving forward, we have to give Democrats some credit. We're not going to rehash it for the zillionth time.
Thank you.
But I do want to ask it in terms of as folks are trying to evaluate whether things are good or bad. The Biden administration writ large walked us off the cliff tremendously successfully, and successful in the sense that we almost didn't notice. Things just got better all of a sudden. But now Trump hasn't been able to get it any lower. Is that because there is some sort of economic barrier keeping it at a slightly elevated rate we've talked about? Is this the new normal? Is it that he's not making it a priority like he promised during the campaign, and there are levers here that he just hasn't pulled yet because he's been more focused on the protectionist stuff? Or is it that he has actually tried to tackle it with some of this protectionist stuff and it's just not working?
Probably too soon to tell. And I think there is some embedded inflation. This last little bit, I guess, before the 2% target seems awfully sticky and hard to tamp down. That's why the Fed has been having this kind of elevated rate posture versus where the 2-year yield is or where inflation is, right, on a real basis. The labor, I think a lot of it is driven by the labor picture, where unemployment is low. Because of that, there's a lot of money circulating in the economy, and that is driving demand for goods. So the Fed is hyper aware of the credibility problem they would have if they cannot return to what they perceive of stable prices, which is, that 2% rate. And I really think that they want to see a 2.0 or below before they cut any further. I really think that's what they're going to wait for, but we'll see. July, they may cut a 1/4 point. I don't know. There's more pressure now on the Fed coming from the administration again. So we'll see.
We wanted to wrap things up by talking about tariffs a little bit. Is Trump helping, hurting? Did he chicken out and go back to the status quo? Or is the economy just too big to care what Donald Trump thinks? And I think on this one, so far with the tariffs, the post-Liberation Day tariffs, seemingly not dragging down the economy the way folks like Banker Bill thought they were, is the economy just so big? Is the global economy just so big that 30% off the top, 10% off the top isn't going to make that big of a difference? Or is everybody hanging on by the skin of their teeth and we're going to start to feel the effects of these tariffs any day now?
Yes, let's look at the customs duties that are coming in. So in the first quarter, there was $96 billion that came in. That's 17% more than first quarter of 2024. So some ones are paying those tariffs, whether split up by the importer, the manufacturer, some piece of it ultimately paid by the end consumer. One thing I want to note that we talked about before was the recent relative weakness of the dollar. So that may be having an additional impact. The money from the customs duties, as I understand it, goes directly to the Treasury Department and into the general affairs budget, where, I think it can be used for anything. I think it applies to the same budget, I think, as like fines do from the Justice Department. I think it goes to the general account. So significant increase in customs duties. Like I said, 17% comparing Q1 25 to Q1 2024. And, you could say some little bit of that is inflation. We talked about that before. Let's call it 2.5 points. So you're still looking at 15% increase year over year in real terms on customs duties. Couldn't have a deleterious effect on GDP. That's what I was taught. That's what I've learned, in all of my experience. But it can be different this time. As it is right now, this could be an incremental revenue generator to the government of somewhere between $300 to $500 billion a year. I think that's the estimate I gave you when we talked about this previously, right? We got to see multiple quarters of this to see how it pans out and start comparing it and get some further data points and see how it ultimately rolls through other aspects of the economy. But ultimately, to your initial point about does it matter? I mean, yes and no. Again, the American economy is incredibly resilient. It's incredibly large. We're buying, we're selling, there's importing, there's exporting. We are not dependent on any one particular thing. It's a nonstop hodgepodge of transactions inside the United States and worldwide, whether denominated in dollars in some foreign country or here. So, there's things that we can do, but at the same time, you just wait and see.
Now, you said those customs duties, those tariffs that we're collecting on, that's up 17% over last year.
In nominal terms, just straight dollars, yeah.
Just straight dollars, right. So obviously somebody's absorbing some of that cost, at least so
Someone's
far.
paying the tax.
If we look at it in terms of goods, though, because I don't know if 17% over all the tariffs, all the different scenarios, what the actual gross total in tariffs is the number of goods coming into the country up, down, or approximately the same?
I don't have it in front of me. I think the trade deficit's actually worse because when you compare year over year, because of all the front loading on the tariffs. So it's, again, wait and see on the impact. You create a step function with the tariffs, and now we have to see how that ripples through the other aspects of the economy.
Do we know what the gross total of tariffs is? Is that even calculable?
I don't follow that, but it doesn't.
I'm just saying if they're paying more duty to bring in less goods.
Yeah.
Doesn't that?
I don't. Okay, I see what you're saying. I'd have to check that out for you and look.
Because there's a scenario in which slightly less goods are coming in, which would signal a slight slowing of the economy, but they wouldn't show up in the tariff revenues because they'd still be up.
Correct. And you've impacted new tariffs and higher rates of tariffs. So even if trade declined, you're probably right. You would see an increase in tariff revenue just because of how they've structured them.
And to me, that just seems like an important because the question
it is.
to me.
No, that's a good point you raised. Sure, trade weight it is what you have to do. I mean, that's really what you're saying.
So in the short term, we're saying it looks like the international economy and the U.S. economy are absorbing the cost of these tariffs
throughout the supply chain.
Supply chain.
Right. Like there could be 15 touch points on this, of which like 12 are absorbing, let's say 8 cents each, right? Whatever it is, 8% each.
Do you see a financial structure that has accepted a heavy load and is holding it just fine? Or do you see a house of cards that's starting to buckle a little under the weight?
That's a good question. It'll take time to tell what that is. Everyone's going to keep dancing until the music stops. I mean, there's people whose entire livelihoods, just think of the trucking and logistics industry alone, trains, trucks, all those industrials kind of industries, anything that moves things from A to B, they're going to find a way to stay in business until they cannot. And if that means eroding their own profit margins to pay for a tariff, so be it. And that probably goes for several components of the supply chain.
I just got one last question asking on tariffs. So we brought in over $90 billion in Q1. When we compare that to the federal budget, when we compare that to the federal deficit, are tariffs really going to put a significant dent into our national debt? Or is this still a drop in the bucket that Trump just gets to parade around?
Well, that's a good question too. Look, at last check, there was like 5 trillion coming in and 7 trillion going out. So you're 2 trillion in the hole. These numbers would indicate, let's just call it the high end, $500 billion in incremental revenue. And let's just assume you can count on it, which you poignantly brought up. You cannot necessarily count on that money. So say it's 500 billion. Yeah, that's 25% of your deficit, right? The problem is, and we talked about it on the Beautiful Bill episode, is the bill that they're putting through now, the Senate, you said they're going to start voting on it on Saturday. Since our episode, since that bill left the House, the cost of it's only gone up. And the projected deficit is supposed to increase under the new legislation, something like $300 billion a year. Let's just say you brought in 500 a year. Your new net's only 200. So now it's 10% of the 2 trillion, right? So you've beat into it much less than you otherwise would have.
So it's real money. It's not like the military parade, which was a waste of money, but wasn't going to make or break the federal budget in any way, shape, or form. So, I mean, 25%, 10%, that's a good chunk of money, but it's going to fall far short of Trump's promise that this was going to not only erase the debt, but allow us to get rid of the income tax. And
but you brought up something important. I mean, I would be interested. That's a good hypothetical of how would that, if at all, change the fiscal outlook of the United States and with it, the immediate impact of interest rates. So you keep all else equal. We have the new bill. The new bill adds nothing to the existing deficit. The same trend we're on, we stay. Okay. So that nominal amount of deficit, it's $2 trillion. I now add $500 billion a year, incremental revenue. My deficit just dropped 25%. It's still not great. It's a $1.5 trillion deficit, but I just punched it down by that much. That's going to save you on interest costs because you don't have to, put out as much money for bonds or notes. And you would expect I would expect there'd be some kind of positive reaction on interest rates, meaning that interest rates would come down. But that's not what we're getting. We're getting basically more economic stimulus with not enough of an offset of the tariff revenue. So, or if there is an offset, it's marginal, right? I don't think that the bill that we're ultimately going to see passed will be a positive for interest rates, at least in the immediate term, because the fiscal outlook, from what I've read, I mean, it would be worse, right? We're going to increase the deficit further, and we're not having any offsets. So I don't, by October, you're right. We'll probably be talking about it, the Fed again, and they'll probably nominate somebody, and then Powell will be a lame duck and for 3, 4, 5 months. Maybe then we'll engage in some kind of yield curve control.
It sounds to me like you're slightly more pessimistic than optimistic at this point.
Yeah, I guess I don't know. I'm really just flying the plane.
Well, let me just ask you one final question of the episode then. Are you making any big purchases this summer?
Going on a vacation to Europe in August, booked it in December. And since we booked it, the US dollar has weakened to the euro by about 15%. So suddenly anything I buy when we're there will be a bit more expensive.
Well, we hope you enjoyed that trip. And we hope you all enjoyed this episode of Is It Bad for the Economy? Thank you so much for joining us. Please, please, please give us those 5 stars on Apple Podcasts and a positive review on Spotify. It helps us reach more people. And if we reach more people, we think that we're all going to be better off with a slightly more rational economic, political profile across the board. Please share it with your friends and family. And if you have any questions for Banker Bill, please leave them in a comment for us. We'd love to explore them and tell you whether we think you are right, wrong, or just a load of hot air. We'll see you in 2 weeks.
I'd like to say one more thing. Happy July 4th to everybody. I hope the weather's good for you wherever you are. You go to the barbecues, go to the ball game, whatever it is, get out there, be somebody, enjoy yourself with your friends, with your family, whomever.
Happy 4th, everybody.
So much, you may even get tired of winning.
Are you expecting a recession this year?
I hate to predict things like that. there is a period of transition. It takes a little time